Hello, I'm Chris Sleight, the editor of Construction Europe magazine, and in this podcast I'll be reviewing the stock markets in 2009 with a particular focus on shares in the construction industry. If you read Construction Europe regularly, you'll know that each month we focus on the stock markets, and if you'd like more details on what I'm going to talk about today, you should look out for the February edition of the magazine. If you don't already receive Construction Europe, please visit our website www.khl.com for more information about a subscription. It will come as a surprise to a lot of people that 2009 was a year of unusually high growth for the stock markets. Despite the miserable economic conditions, the markets put on some very useful gains. The biggest for any year of the mainstream indicators was Germany's DAX, etc., which was up more than 19% over the course of the year. In the UK, meanwhile, the FTSE 100 was up more than 18%, while Japan's Nikkei 225 rose more than 17%. And in the US, the Dow was up more than 15%. It was a record year for the construction sector, with the CET index, our unique basket of 60 European construction companies' shares, growing a massive 37.9%. This broke the previous record for annual growth of 36.8%, set at the height of the boom in 2009. However, all this has to be seen in the context of the previous year. 2008 saw the mainstream indicators lose anywhere between 32 and 42%, as financial institutions on both sides of the Atlantic had to be bailed out. The turning point was, of course, in September, when Lehman Brothers was allowed to collapse rather than be rescued by the US government. So while 2009 was a miserable year for the real economy, it was 2008 that saw the real downturn in the financial sector. In fact, the stock markets were still falling for the first 10 weeks or so of 2009, and they didn't bottom out until mid-March. However, as this graph illustrates, the rest of the year saw almost uninterrupted growth, with perhaps only one hiccup around July. The major indexes and the CET index alike finished 2009 at or close to their 12-month highs. So that was the basic pattern of the markets in 2009, and as I said earlier, it was a record year for the construction sector. However, what was unusual is that the growth came from materials producers, a sector that is normally much more subdued in terms of growth than contractors or equipment manufacturers. But this graph illustrates just what a phenomenal year the materials sector had. The CEM index measures growth in this area, and as you can see, it was up more than 60% in 2009. That's obviously a lot compared to the mainstream indexes, which grew in the high teens last year, but it is also a lot for the more volatile construction sector. For example, this growth smashed the CEM's previous record, which was for a 25% rise in 2005. The index measures capitalisation, the number of shares multiplied by their price, and one of the reasons it grew so much last year was the large number of share issues in the sector. More than half the companies that make up the index issued shares, increasing the total number in circulation for all companies by about 15%, from 11.4 billion at the start of the year to 13.2 billion shares by the end. Having said that, materials producers were among the top risers last year, with Wolseley topping the list and Coney also doing well. Among the contractors, it was the Nordic companies that stood out, with the likes of YIT, NCC, Veidekke and Peab all in the top 10, and Lemminkainen and Skanska just outside it. Taylor Wimpey, meanwhile, bounced back from a terrible year in 2008, when it was the worst performing share in the construction sector, losing more than 93% of its value. Among the equipment manufacturers, Metso and Hitachi led the way, and there was also good growth for companies like Atlas Copco and Sandvik, which, like Metso, have a big presence in mining, as well as for Komatsu, which, like Hitachi, has a big presence in China. It remains to be seen what 2010 holds for the markets. The growth we saw last year was due in part to companies maintaining what profitability they could by cutting costs. Now there are no more costs to cut, and it will take a genuine recovery in demand for profitability to improve further. As I said at the start, we look at share prices every month in Construction Europe magazine, and if you would like to follow this subject more closely, please visit our website www.khl.com to arrange a subscription. Alternatively, you can email circulation@khl.com for more information. Thank you for watching.